Hi, it's Harry with the Rant on February 10th, Friday. Now, this is a really important time for the markets. It took forever for the markets to finally have that first crash that says we've really likely put in a long-term top. That was 34% for the NASDAQ into June, and then a lower low in October, 38% down. That qualifies from all the first crashes and bubbles I studied back for hundreds of years, 28% minimum, 50% maximum. So that qualified. The S&P was down 28% just into that, okay? But again, that was the first sign that we finally made a major top, okay? Now that we had this crash into June and then slight new lows into October, we are now in a bounce. This bounce will be going on later this month, like late February, early March, will be going on 5 months. That's as long as the bounce was from the 1929 to 32 first crash and bounce, okay? So that's about as long as it should go. And I have a target, 13,186 on the NASDAQ. That's an important number. That was the August big bounce high, and that is the resistance on the upside. So nothing wrong with the market continuing up, as I've been expecting and been warning, up to about 13,186. If it starts breaking through that, it starts looking like, well, maybe the market's not ready to crash, okay? Have the crash of a lifetime. Now, the more important number is the October low in the NASDAQ. 10,088.89, okay? If we break below that, and I don't mean just go a few points below and then turn around rally. If we break cleanly through that, that is a sign that this third wave, which I think already started in mid-August, okay, in that bounce, I think we're already in this third wave. We've seen the first part of that down. This bounce has lasted, again, long time, but if it breaks then, that would show that the third wave is kicking in, and it should be at least as long as the first wave. And next thing you know, we're down near the COVID lows. That is 55% down on the S&P, 58, 59% down on the NASDAQ. That's when investors and consumers will say, oh my gosh, the Fed's lost control. Oh my gosh, yes, we are going to be in a recession. In fact, you know what could cause this recession? Because it really hasn't fully happened yet. It keeps looking like all the signs are we're going to go into recession. But a stock crash. You got to remember that the top 20% control 88% of the financial assets, stocks and real estate. So when stocks go down, these people are more likely to pull back, and that's enough to throw us into a recession, even though it's kind of like the economy keeps threatening to go into recession, it doesn't. I think the stock crash could actually cause the recession. So this is an important point, okay? We're right in the middle here. So we could go a few percent higher and hit that 13,186 for people who want to short stocks. This is not the time, the first crash happened. That would be the time to short stocks. Again, for people who didn't sell all together, and holding back, that's your last chance if we get there. And I think that is likely. So, and again, the cycle suggests this bounce should not last past early March. So we're talking weeks for this. And if it goes longer than that, and again, if it breaks above 13,186, then the market just may not be ready for the crash of a lifetime, and it would mean the Federal Reserve is probably going to pivot back, which everybody's hoping, towards neutral to maybe even stimulus again. So I don't think that's likely, by the way. Once the Fed has gone to tightening, it would look foolish for them to quickly reverse that. And they're supposed to be fighting inflation, and they created with this massive bounce. You got to remember, the economy changed in March 2009, okay? When we hit that low in stocks, stocks should have gone down 80% and been down into 2010 instead of March 2009, okay? And unemployment should have been 16% instead of 10%, that sort of thing. We should have had a deeper recession then, more like a depression, but the government, Federal Reserve, and central banks around the world said, no, we're going to stop this, and they stopped it. Literally 57% in, okay? The market was down 57%, okay? And that's exactly in the same time period, 1929 to 32, at that same time period, the Dow was down 57%. So they stopped the crash, 57% instead of 80 to 90%, okay? So again, we should have to see that crash in the future, okay? If the markets win here. If the Federal Reserve just takes over, we may just end up in a mediocre economy like Japan forever and never have a real depression or big stock crash, but maybe not ever see new highs substantially. But I don't think that's the case. So, but 10,088, we break through that. I don't mean just break it again a little bit and turn around. We break through that. Third wave's in gear. Next thing you know, we're testing the COVID lows, down 55% on the S&P, 59% on the NASDAQ, and then people know the economy's in trouble, and then consumers and businesses pull back more, and then we have the crash of a lifetime. And recall, this would be the third wave. Remember, big crashes or bull markets, one wave down in a crash, two wave bounce. We're in that two wave bounce still. Third wave should be as strong or stronger than the first wave, usually the strongest wave. That will be ahead of us if we break 10,088. And then a bounce maybe late this year, and then a final wave down to bottom in sometime in 2024. I'm guessing summer of 2024 at this point, but we'll have to see. So this is the time for the markets to finally show its cards. Of course it's waiting. Of course it's holding out. It doesn't want you to know, okay? If it's going to crash, we should see a crash. We should break that 10,088 in the next month or two max, really, literally in the next month. We should break it by early March would be best. And then we'll be on the way down, and then we will be in the crash of a lifetime, and you will be happy that hopefully you got out of stocks and real estate. I'll keep you updated.